Hey, it's Martin. Hope you're doing well. Just wanted to take a few minutes to talk with you about interest rates and what I see might be happening here for the future of rates. I'm getting a lot of calls from clients and realtors alike asking me, well, what do I foresee happening? What do I expect for the summer of 2017 and going forward? And the truth, the honest is I have no idea. I really don't know. I try to study this as much as I can, try to get as informed as I can so I can share that information with you and my clients. But right now we're in a very turbulent model from both the political environment and the economic models that we're looking at to try to suggest, where rates may be going. But we're definitely in a rising trend right now, and I want to share with you what I think might be happening here. A couple things. First of all, today's March 14th, and tomorrow on the 15th, we expect the Fed to wrap up their two-day Fed meeting and make the announcement that they will probably be raising the Fed funds rate a quarter point, which means that they're going to start raising interest rates again. Now, these are the interest rates that control short-term money. It doesn't necessarily translate to mortgage rates, but there is a dotted line connection to some of that. I'm going to show you how that works. Basically, the Fed right now is looking at a couple of things. The reason they're going to raise the rate tomorrow is because they're starting to show signs that the economy is beginning to pick up, and there's signs of growth. I mean, we've seen the job numbers that came out in February is one of the highest they've seen in recent years, and there's been a very steady trend right now for job growth in the last few months. The other thing that's starting to show up is inflation, which is perhaps the biggest reason why the Fed is going to raise rates, because the inflationary numbers that came out today based on the Producers Price Index, that's called the PPI, measures inflation at the wholesale and manufacturing level. So that's basically what does it cost to make the goods and services that are going to be sold, and how are manufacturers absorbing those costs? Now, the truth is, they will pass that along down the line to the extent that they can, and tomorrow we'll get the Consumer Price Index, which really measures inflation at the consumer level. We expect those numbers to come in fairly strong because they're starting to see a trend of inflation starting to show up. And for that reason, the Fed will raise rates, which will help to tame inflation and keep things in check. That's a big part of their job, which was what they're going to do. Now, that ties into what happens in the mortgage industry, all right? And what I want to show you here is, let me get my screen here updated here, is this chart that I refer to all the time. Now, this is the Treasury. This is the 10-year Treasury. And as you can see, it's like a roller coaster. It's up and down, up and down. And here's where we're at today. We're just beneath this 2.6 line. And that's an interesting number because 2.635, which is what this line right here represents, is the highest that the Treasury has been in the last 3 years. In fact, if I follow this line across, the last time it touched at that level was here in, was it September 22nd, September 18th, thereabouts of 2014. So what it's telling me here is that interest rates are starting to reach the highest level they've reached at in the last 2.5 years since September of 2014. If we break above this level, we can see a definite rise in interest rates. So the question is, what's going to happen tomorrow? Are we going to come bounce off this ceiling and come back down, or is it going to break through this and continue to go up? So to give me a little more insight on that, I wanted to take a look at another chart. Let me switch screens here. This chart takes me back and kind of gives me an example as to what's been happening in the last 25 years with the Treasury. Okay, we are currently right here testing this red line. Now, this pair of red lines here that I've drawn, this line here and this line here, shows that there's been a very clear and definite trading channel of the bond market in the last 25 years, going back to the early 1990s and late 1980s. And you can see it's been in this up and down, downward trend, but it's always stayed between these red lines. Right now, we are right here. If we break out of this channel and come to the upside, then there's a very good suggestion that rates will rise significantly. I'm hoping that I'm wrong on that. I'm hoping that we're going to hit this red line right now and start to trend back down. But this is the yield, which we've been running right around in the mid-twos in the last, few months or so. I think this is 2.6 is what I was showing on this chart, which is where we're at right now. This is 2.62 is currently where we're at. So 2.62 puts me right here. And, historically speaking, that's still extremely low. But that's the money that's being, bought and sold and traded. Now, this is the 10-year Treasury we're looking at. The mortgages are actually priced off the mortgage bond market, but the two work very closely. So what I want you to understand is this. If we break above this tomorrow, we're going to start seeing rates possibly, take a significant run up, because we will be in uncharted territory. We've never been in that area. If we can stay within this trading range, then it's reasonable to think that rates, will stay in the general vicinity of where they have been right now, which is in the mid-4s. But I'm afraid that if we go above that, we'll start seeing rates move very quickly past their current, levels, and possibly start getting back into the 5s. Which, again, historically speaking, an interest rate of 5 or 5.5 is still a relatively good interest rate. But we've been accustomed to rates in the low 4s, high 3s for the last few years, and for a lot of homeowners and potential shoppers, that's going to be a little bit of a shocker. So, my advice is this: if you're looking to buy real estate, the quicker you can get in and lock it down, probably the better for you right now. For those of you who are looking to buy real estate in the next few months, keep an eye on that. If there's an opportunity to do a long-term rate lock, do that. Lock in today's rates. For example, if you're buying new construction and the house is going to be ready in a couple months, maybe you can lock in the rate now and you don't have to worry about any of these oscillations in the market. As always, if you have any specific scenarios, you want me to crunch some numbers for you, give me a call. You can always reach me here at 661-244-5896, and I look forward to helping you. Have a great day. Thanks. Bye-bye.